What's up everyone, it's Caddy with MoneyVest, and in today's video we are going to be talking about Netflix. And Netflix has been selling off pretty aggressively this past week. In fact, it is down a little bit over 9.5%, almost 10% down after the comments from the CFO. So I'm going to break down exactly what he mentioned. We're going to talk a little bit about the intrinsic value, which has changed dramatically since we have started incorporating the free cash flow into our models as well. And of course, talk a little bit about the technical analysis and what could be the next stop for Netflix from a technical perspective and from a support level standpoint. So hope you guys enjoy this video and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, everything is going to be included, as well as the members only private videos and of course the intrinsic value spreadsheets and the members only private videos, like as already mentioned. So links are going to be down below and we'd love to have you on board. Now, this right here is the sell-off, of course, 9.5%, coming down to low 400s. So this is where we are, down about another 2.85% on the day. And Netflix, of course, has had a quite an interesting story in the last 3 years. I mean, it kind of rallied after the pandemic got started because everybody was literally at home and streaming really, picked up during that time. But then, of course, as we reopened the economy and Netflix was struggling with competitors with Apple TV, we've got Amazon Prime, we've got so many other, Disney Plus, of course, came out during that time as well. So battling through all the competitors and, of course, struggling for relevancy in the long term. The stock sold off quite aggressively. We also did have Bill Ackman during that time also selling off because of some earnings misses. And he said, we don't have the time to wait around for Netflix to be back at those levels. And we'll tell you what, since June of last year, the stock is up over 172%. So it has performed really well in the last 1 year. So you can come down and take a look. 1 year return up over 82%, not to mention from June specifically, it's up about 172% after being down a little bit over 75%. So it's been all over the place. And of course, majority of this rally came from the pivot away from the Netflix's ad-free business to now an ad-supported tier. And not to mention password sharing that they're going to crack down to over 100 million subscribers or people that are using either their friends or their family accounts to access Netflix, which obviously is a crazy number. Imagine what would that do to the revenue and the earnings if they were all paying customers for Netflix, right? So it's been all over the place, but more recently though, the CFO mentioned that Netflix drops its ads tier not seen driving revenue in the short term. So Spence Newman said the streaming service saw a muted cancellation reaction after a crackdown on password sharing. An estimated 100 million people were not paying for a subscription and taking advantage of a family and friends account. And Newman said, quote, revenue is building and will continue to do so through 2024. And those spin-off subscribers, however, are trending more towards the ad-free viewing, which isn't ideal for building up an ad business. Now, if you think about it, this is actually a good thing, right? This is a kind of like a benefit, right, in disguise, because yes, they want to build up their ad-supported tier business, but if people that are spinning off from after the crackdown and they are actually opting into the normal subscription, which is ad-free, that's a good thing because that's a higher priced tier and Netflix is adding more revenue and adding more profitability and margins to the business, right? And he goes on by saying, and I quote, we have to scale the reach of our ads tiers. Of course, the goal right now is to build the ad-supported tier business. But if this revenue crackdown, this password sharing crackdown, forces people to join Netflix on its own in an ad-free tier, which is just like the normal basic Netflix subscription plan, that's actually a good thing, right? That should be a good thing. And even though it's been disguised as a bad thing because it's not building up the ad-supported tier right now. And the thing is that if the ad-supported tier doesn't have a lot of people or subscribers, advertisers are not going to want to spend money to advertise on that platform, right? Why is YouTube so successful? Why is Meta so successful? That's because YouTube and Meta have billions of people on their platforms, and that's why advertisers want to target those people. With Netflix, I mean, if their ad-supported tier doesn't have those types of volumes, it's the advertisers are not going to be paying that much money. And to be honest, I mean, Netflix is working with 200, maybe 250 million subscribers right now. YouTube and Meta are miles ahead. They've got billions of people each month that are logging into their platforms and, of course, accessing content on their platforms. So advertisers, just simple math, right? Advertisers want to target these billions of people. They're going to want to be paying a higher rate versus Netflix, which of the 250 million, 300 million, even if 10% come on to an ad-supported tier, which is 10 to 20 million, 30 million, that's not enough, right? That's not enough for advertisers to basically see that conversion, right? So for that reason, it's going to take a long time. It's going to take a significant amount of time for Netflix to build up their ad-supported tier because it's a two-way street, right? It's not just ad-supported. So in other words, the businesses won't come until the people show up, right? And the people won't show up until the company Netflix starts to promote ad-supported tiers. People don't care about ads anyway, right? We don't want to see ads. But it's for businesses' benefit. They want people to join this tier. And if they don't, of course, ad-supported tier, this ad business is not going to flourish. But as I said, I mean, if people are actually going towards the normal subscription model, that's still a big plus point. I mean, still, that's a huge benefit for Netflix. And Newman also pointed out that huge continued growth opportunities given that stream is less than 40% of the US market and far below in others. And the total TAM, the addressable market for Netflix, is 600 billion and revenues were 30 billion. That's still 5% of the total. And the executive also said games remain a relatively small percentage of the content budget and won't see a big impact on growth in the short term. And finally, he doesn't see sports being profitable either for Netflix. Now, this right here is the overall fundamentals of the company. You can see very nice consistent growth going from $4.3 billion all the way to over $32 billion in trailing 12 months. Gross profits gone from $1.2 billion to over $12.4 billion, and operating income's gone from $228 million to over $5.6 billion. So very nice consistent growth here from Netflix. Net income's gone from $112 million to over $4.2 billion. Shares outstanding have been relatively flat. They've only gone up by like 0.5% per year. And of course, revenue per share, diluted earnings per share, and EBITDA, everything has moved in the right direction, pretty much gone up to $5-6 billion of EBITDA right now. Now, when it comes to margins, they are working with pretty solid margins at 38% gross margins, although it is a little bit lower compared to the sector median, and their 5-year average is slightly lower, but it's more or less the same. We got net margins at 13.2%. This can certainly improve for the company. And I'm actually quite surprised that for streaming, 38% is the gross margin. I was assuming it's going to be a little bit higher, but it is one of those businesses that needs to keep producing, right? It needs to keep producing content to keep the users and keep the subscribers basically engaged. And the moment they start producing is the moment they start being complacent and subscribers fall off, right? So it is quite an interesting model, very similar to most YouTube content creators, right? It's like a business model that we also operate in. It's like constantly on the hamster wheel where we are producing content to keep everyone engaged. And for that, there's a lot of time and energy and resources and capital invested to be able to produce the content. And that's the same thing with Netflix, right? Net margins, 32% here. Return on common equity, we got 20%. Return on capital at 9%. And return on assets, a little bit over 8%. And net income per employee has been very, very flat, $331,000 per employee in profit. Free cash flow, also very strong, from $2.4 billion to over $17 billion for the company. I'm actually quite surprised that CapEx has been a little bit lower more recently. So it's gone from like $500 million to like just under $360 million, $407 million. So that ROI continues to be very strong. And we are going to include for free cash flows as well for Netflix and kind of calculate the new intrinsic value after accounting for the free cash flow as well. Now, balance sheet's always been a little bit of an issue for me. So the only reason I've been always hesitant of investing in Netflix in the first place was the balance sheet, because they do have a lot of debt of almost $17 billion, total cash sitting at $8.5 billion, and we've got a current ratio, quick ratio of over 1.3, 1.1, and of course a debt to free cash flow at under 2. So all those metrics are good. apart from the level of debt the company has on the balance sheet, right? So cash 8.5 billion, debt is almost 17 billion dollars, which obviously is pretty significant number for the company, which makes their net debt at positive 8.4 billion dollars. Now, it is a growth stock. No doubt Netflix is a growth company because the expectations are pretty aggressive here. They are expected to grow earnings anywhere between 18 to 21% over the next 9 to 10 years. And earnings are expected to go from like $12 all the way up to $61 per share for the company. So if we plug in some of these numbers, we're looking at a compounded annual growth rate of 19 to 21%, as I mentioned earlier, for the next 5 to 10 years. I just learned that this CapEx and this free cash flow is not indeed accurate. Seeking Alpha, get your stuff together. What the heck is going on? They basically have free cash flow for Netflix. So you can see that I'm on Netflix's page here. Free cash flow all the way down. They've got free cash flow sitting at $117.8 billion, which is farther from the truth. If you come over to the company's own financial statements, this is from 2022. Free cash flow, non-GAAP free cash flow right now is sitting at $1.6 billion. This is for the 12 months ending in December 31st, 2022. Because they had that operating cash flow at $2 billion and then a CapEx of about $407 million. So you got $1.6 billion, right? Because free cash flow is basically operating cash flow minus CapEx, so $1.6 billion. And so far in the 2023, for the first 6 months, so 6 months ending in June 30th, 2023, they have a non-GAAP free cash flow of about $3.45 billion. So if we account for $3.45 billion, annualize it for the entire year, that's going to be just under $7 billion. $7 billion is what I'm going to plug in into my spreadsheet here. 6.9, almost $7 billion. And that is going to be a growth rate of about 11% for the company, right? So 11%, I'm going to go with a little bit more of a higher number at close to 14%. I'm going to go net income growth, in other words, earnings, to be about 20%, so 2020 for income and PE multiple. Free cash flow of about 14% growth. We're going to keep the price to free cash flow multiple at 20, discount rate of 12%, margin of safety of 10%, 50 basis point share dilution. We're going to give it 50% in equal weighting. And now we come down to a fair value of, once again, sub $300, right? $294, closer to $300 is where the fair value is going to be for Netflix. And right now, of course, it's trading at just over $400 per share. So it still has a little bit more downside needed in order for this to be trading at its fair value. And this right here would be the level where I would be watching for the fair value for Netflix. So this right here is going to be that intrinsic value / support, technically speaking, for Netflix. So it is down a little bit over 9.5%, right now sitting right at that support at 397, sub 400. If it does end up breaking down below this level, the next support is going to be down to $379 for this company. And of course, I would be waiting and watching at sub $300, but I do still am hesitant because of the valuation for this business, and not to mention the balance sheet, which is a little bit of a concern as well, given how high the debt levels are for this company. So hope you guys enjoyed this video. Let me know your thoughts down in the comment section below for Netflix. Are you buying, selling, or holding? What are your thoughts? As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.